Hey everyone, today we're going to talk about rentals versus doing flips. What we're going to discover today is that rentals have a lot of advantages that flipping does not have. So today we're going to look at the 4 big differences between rental real estate and flips and why these are important and the impact that they can make to your overall tax liability. So the first one we're going to talk about today is the capital versus ordinary treatment. So let's talk about the downsides first. If you're doing flips as your main business, and sure, you're generating some of these bigger profits quicker, well, because you're holding them for under a year and because you're probably really considered to be treating real estate as more of inventory than an asset that is really generating income, and you're holding it out for sale, you're going to get ordinary income treatment. And that means that you're paying a higher tax rate than you would otherwise if you can push it into the capital gain treatment. So if you're selling flips, you're here in the ordinary world. Where you want to be is in the capital world if you can, from a tax perspective. So capital gains is for assets that are held for more than a year. Rental real estate being one of those assets that qualify for this treatment. So if you can hold real estate for at least a year, rent it out, generate some of that cash flow during that time, and then you decide it's time to sell for whatever reason, well, then you can get this capital gain treatment, which is a lower preferential rate. So that potentially actually increases your in-pocket income and allows you to do more. So to the extent you can, you want to generate capital gains, and that's just the first reason why rental real estate would be better than a flipping business, purely from a tax advantage. The second reason that rental real estate is a huge benefit is because you're taxed on your income, and I'd also put in parentheses potentially loss, not cash flow. And so the concept here is that when you're doing a flip, you're really taxed on dollars you're bringing in, right? So let's say you expend however much, $100,000 to buy something that needs to be fixed up. You put in $20,000. After you've done the work, it's now worth $150,000. So what's your profit, right? You sell it for $150,000. You take off the $20,000 you put in repairs, $100,000 for the original cost, and you have $30,000 in profit. Well, that's what you're going to be taxed on. However, rental real estate, you don't necessarily pay tax on your cash flow, because one of the big differences, one of the advantages of real estate is that you can take depreciation deductions, which is something that we'll talk about in another video in more detail. But essentially, depreciation is this fake deduction that is essentially saying that the property is worth less from a tax perspective, does not necessarily correlate to the real economics of what's happening. So every year you're taking this depreciation deduction while you're collecting rents. And so you can potentially either show less income on your tax return than actual dollars you're putting in your pocket. Or in some instances, when it works out in a perfect world, you can create a loss for tax purposes and actually have positive income. The third big difference is that on rental real estate, you don't have self-employment income tax on that. So self-employment income, this is, think of if you're self-employed, you're not only paying your ordinary tax rate, but you're also paying this additional tax because you're self-employed. If you're an employee, then this is the part where the employer's paying half and you're having half deducted from your paycheck. Most, income, wage income is subject to self-employment, but there's a specific exemption for rental real estate is not subject to it. So if you're generating a significant portion of your income from rental real estate, you're likely not paying self-employment income tax. Now, if you have a flip business, that's very different, because flipping and selling the assets is not specifically exempt from self-employment. So if you're treating it as a business and this isn't an investment and you're flipping on a regular basis, you're not only paying this ordinary income tax rate, but now we're going to go ahead and compound it and you're going to pay the self-employment income tax. So again, huge advantage to rental real estate just from one of these alone. Combining all of them together is just an incredible difference on the tax you'll pay. So let's jump into the last one here. And this is a great strategy for being able to increase, the size of your portfolio. Is essentially you can refinance rental real estate tax-free. So instead of selling the property to pull your equity out and then investing, where you're paying tax on it and then you have less to invest in the next project, you can instead, if the value's increased for whatever reason, you've increased rents, maybe you've done some improvements, or maybe the general market like it is now is just on an up, then and you can refinance it and pull some of that cash out where you're not going to be taxed on the cash that you pull out, and you can use it to invest in another property. So this is a great tool to generate some of that cash flow, but not pay tax on the income or loss necessarily. So these are the great, the big 4 advantages of investing in rental real estate as opposed to a flip. And I'm not saying don't do flips. I'm just saying when you look at your business as a whole, taxes are a huge expense, and you want to consider everything when you're making business decisions. So I look forward to seeing you all in the next video.